The US and China's trade war has evolved far beyond just tariffs on electronics and agricultural products. It's now deeply embedded in the energy sector, with China making seismic shifts in its oil and natural gas imports. So what's at stake in this high-stakes energy battle? Why is China turning away from the US and pivoting to countries like Canada, Russia, and even Qatar for energy deals? And what does this mean for the global energy market in 2025? Let's dive into the heart of this ongoing conflict and break down what's really happening with China's energy strategy and what the consequences are for both the US and the global economy. The trade war landscape. It all started in 2022 when China and the United States began imposing aggressive tariffs on each other's products. Under the Trump administration, the US aimed to bring Beijing to its knees by targeting Chinese electronics, machinery, and, perhaps most surprisingly, energy. In 2023, when President Biden took office, the situation didn't improve much. The tariffs stayed, with China retaliating against the US by imposing tariffs on crude oil and liquefied natural gas, LNG. Fast forward to 2025, the trade war between the two nations continues to escalate, and energy trade is at the epicenter. The shift away from US oil. In the early years of the trade war, US oil was a hot commodity in China. Affordable American crude oil and LNG helped China close its massive energy deficit. Between 2017 and 2018, the US became one of China's top suppliers of crude oil, with shipments peaking at over 300,000 barrels per day. However, this trend has taken a drastic turn. China has now slashed its oil imports from the US by 90%. The reasons are clear: tariffs ranging from 25% to 30%, coupled with growing geopolitical tensions. According to Bloomberg, China has turned to Canada as its new oil supplier, with imports from Canada hitting historic highs. The shift is not just about economics. Canada offers China a more stable political environment compared to the volatility of US-China relations. China has also been strengthening its energy ties with Russia, particularly since the escalation of the Ukraine conflict. Energy trade in 2025, China's new alliances. In 2025, Canada is making a big splash in the energy market. Chinese state-backed energy companies are now purchasing Canadian oil at record levels. In the past 3 months, China's imports of Canadian crude oil have nearly doubled, as Canadian producers ramp up their oil extraction from the Alberta oil sands. This move is part of China's broader strategy to reduce dependence on the US and diversify its supply chain. Meanwhile, Russia has been providing China with discounted oil, an attractive option due to the ongoing conflict in Ukraine and Western sanctions. Russia's energy exports to China have surged, with Moscow offering crude oil at a discount of $10 to $15 per barrel. The impact on US producers. So what does this mean for US energy producers? With China slashing its oil imports by 90%, according to the US Energy Information Administration, US crude oil exports in 2022 reached 3 million barrels per day, with a significant portion going to China. The role of Canadian oil. Canada has emerged as a critical player in this new energy landscape. With its heavy oil resources in Alberta and a relatively stable political environment, Canada is now seen as a more reliable partner than the US for China's energy needs. In response to this shift, Canadian companies are expanding their production capacities and building new infrastructure, including new terminals and pipelines to increase oil exports to China. This is not just an energy deal, it's also a political move. Canada, which had previously been at odds with China over issues like Huawei and technology restrictions, is now more willing to strengthen its ties with Beijing. For China, this is a strategic decision. By diversifying its energy sources, China is not only reducing its reliance on the US, but also strengthening its political leverage in the global energy market. The global consequences. As China moves away from US energy imports, the implications for global energy markets are enormous. Energy giants like Russia, Saudi Arabia, and OPEC are watching closely as China strengthens its ties with Canada and Russia. The shift in supply chains means that oil and gas prices could fluctuate significantly. For the US, the question is, can they recover the lost market share? The answer remains unclear. While US oil companies are trying to find new buyers, the competition is fierce. Europe, which has been increasing its LNG imports due to the Russia-Ukraine crisis, is not necessarily open to U.S. LNG due to price concerns. The U.S. and China's energy trade war shows no signs of slowing down. With China's dramatic shift toward Canadian and Russian oil and gas, the global energy map is undergoing a fundamental transformation. In the short term, the U.S. will continue to feel the economic effects of losing a giant customer like China. However, with both countries locked in this trade war, the question remains, how long will this new equilibrium last, and what will be the ultimate cost to the global economy? As the U.S. energy sector continues to adapt and explore new markets, China's pivot to alternative suppliers shows the growing power of energy in this global tug-of-war. It's clear that energy is not just a commodity, it's a geopolitical weapon, and in this battle, the stakes are higher than ever. Drop your thoughts in the comments, and don't forget like and subscribe for the latest updates on global politics.